Okay, in this video, we're going to look at what we do when we've done a backtest and how we make the decision as to whether we take it to a live environment or not. We're going to focus on MT5, but the principles are relevant across other platforms too. And what you're going to get is a key metrics checklist to enable you to put some things into place that's going to make things a little more objective rather than just being taken in by the excitement of putting your EA live. So let's start with just a few assumptions. So first of all, just to say these are my criteria, you've got to define these for yourself based on your own risk tolerance and trading style and your objectives for your EA trading. I would tend to test for a minimum of 2 years, must show at least consecutive gains year on year, and ideally at least one out of sample tests should be carried out. Backtest must be on tick, use reliable spread, slippage and commissions within any calculations on the metrics that you're seeing. So that having been covered, this is a typical backtest we see with lots of interesting and wonderful numbers. This is actually a very good backtest, generally speaking, but key factors like net profit and balance drawdown and equity drawdown, win rates, recovery factors, Sharpe ratios and profit factors are all things that we have a look at that we'll go into in this video. So let's look at our first set of criteria. The first one is profit factor. This is, as a definition, gross profit divided by gross loss. We're looking at a suggested level of in excess of 1.5, but I would say ideally I'd like to see over 2.5. And what this does is it provides you a profitability buffer against spread, slippage and regime changes that you'll see in a live environment. Of course, we can legislate for that to some degree, which we might reference later. The second is our net profit to maximum drawdown ratio. We look at our net profit, we divide that by our largest balanced drawdown in dollar terms, looking for in excess of 8 times, ideally maybe even 10 times net profit to drawdown. Many of our EAs are significantly higher than that. But again, what we're trying to do is stack the likely disparity between backtest and live environments in our favor. And of course, we are looking at getting a reward that's very positive relative to the worst case scenario equity drop. And remember, when we're looking at maximum drawdown, we're not looking at a decrease from our starting position. We're looking at a decrease at any time within that period of testing. Now, win rate, although it's very, very dependent on the average win and average loss of a particular EA, there is a psychological benefit of seeing wins, particularly as you start out in your EA journey. Although we can easily make money if we've got a 35 or 40% win rate, providing our average win is 2 or 3 times our average loss, that will be good. But to see loss after loss, which it often results in if we have a low win rate, possibly isn't good for your mental state as you're starting out, as you become more experienced, and possibly have a few more EAs that are trading in different ways. Then win rate becomes less important than some of the metrics. But to start with, it's worth referencing it because it is important that you feel confident as you begin your EA career. Maximum balance drawdown, we've already referenced this. This is our largest drop from peak to trough. I put in the suggested level of less than 5% of starting balance. Ideally, I would suggest less than 3. But of course, in percentage terms, this is dependent on the size of your account. So a $300 drawdown on a $10,000 account is very, very different to $300 drawdown on a $2,000 account. So it's important that you read this in dollar terms also, and of course use that other metric, the net profit to balance drawdown ratio. What we're looking for is to keep any live swings in capital small enough for safety, both in terms of capital and our emotional state also. If we look at our next set of criteria, number 5 is a Sharpe ratio. This is a reasonably complex calculation, but essentially what it does is it looks at the average excess return divided by the standard deviation of returns. You don't have to worry about the underlying calculation. What you have to worry about is the level. Most textbooks would say a Sharpe ratio in excess of 1 is good. I would say from EA point of view, over 2 is what you should be looking for. A higher Sharpe ratio in essence means more consistent risk-adjusted returns. Number 6 is consecutive losses, and this is your longest losing streak in your test. There's two reasons for this. First of all, you need to build up reasonable expectations. If your expectation is you're only going to get 2 consistent losses and a spin and you end up getting 8, that may suggest that there's a larger disparity than you hoped from your backtest. So it must fit within your account's risk limits, of course, because if you keep on losing consecutively, then that's not good for account balance. But plan for at least 25 to 30% worse than the backtested worst run. That's what I would suggest as a yardstick. Our next is maximum equity drawdown. Although we have covered this, balance equity drawdown is the most important. I would suggest this is worth keeping an eye on, primarily because a large disparity in balance and equity drawdown may mean one of two things. First of all, it may mean that your exits could do with a little more optimization, or perhaps another exit approach put into your EA to reduce this. But the second and probably more important is it may threaten your account balance and ultimately margin calls, which are obviously based on the equity in the account at any particular time. So if your suggested level ideally is less than 3%, then possibly less than 5% is a good start point. Although, again, you can play with this a little bit from your own personal preference point of view. Some of the scalping models will have significantly larger equity drawdowns than this just because of the way that they trade. But again, just look at that in dollar terms, that equity drawdown, and decide whether it's acceptable. Our number 8 is minimum trades. This is the number of executed trades in the test period of the back test. As a start point, perhaps 50 trades a year. Less if you're putting things like market regime filters in, but this is in one direction. Of course, many EA traders decide to optimize for long and optimize short because markets often trade differently depending on the direction. And what we're looking for here is enough trades to suggest that there may be some reliability in the results that you've achieved. For example, if you only had 5 trades, the results you get are likely to be less reliable than if you had 55 or even 505 trades. This creates a problem for long-term systems where you need to test enough years to get a meaningful sample. And so you may adapt this to some degree based on the type of trading that you do. And the last thing I would do, without it being specific criteria, is to check in on your equity curve. What we're looking for here is steady progressive growth, ideally with smaller drawdowns relative to gains, and those recoveries from drawdowns are relatively quick. You may see periods where it flatlines or drops back a little bit, but that's okay, and record those as part of your expectations for what may happen in a live environment. Single spikes may be due to single events. Just take that into account in your calculations. It may not be a reason not to go live, but it's worthwhile are taken in context. So those are our 9 things I would keep an eye on. Of course, remember, as we said right at the start, you need to set your own criteria based on your own preferences, your strategies that you're trading, and of course your risk tolerance. Bear in mind there's usually a disparity between backtest and live performance results. Take measures, of course, to potentially limit these. For example, you can use things like a market regime filter and, of course, legislate for a lesser performance live, at least 30%, I would suggest. And, of course, it's your responsibility to constantly monitor how your EAs are performing in a live environment. And, of course, have similar criteria if you choose to move from minimum volume to scaling at any stage. Hope that's been useful and giving you some guidance as to how you may put your criteria together. Trade safe and see you again soon. Bye bye for now.